So welcome friends, welcome to the case study video. This is related to the topics guarantees, loan documentation and charge of securities. This is from your module C of ABM, paper 1 of CAB. Okay, so now before I start, I would like you to again watch the concept videos. I have highlighted the concept videos here. If you have not watched them, you can watch this related to documentation, guarantees, and securities. And then, if you come to solve this case study, it would be easier and you will understand it faster. Okay, let's anyway start with the case study now. So case study is Zenith Agro Industries Limited. It is a closely held private company engaged in agro processing. It has applied to the bank for 50 crore term loan to expand operations, and this is the proposal. Now always remember, when you are looking at case study in the exam, just be very attentive to the small details they are mentioning. For example, it is a closely held private company. So when that comes, what are the rules of guarantees for such companies? Then it is using, trying to expand operations. So such kind of points always need to be kept in mind while solving these questions. Now let's have a look at these other details. The security offered. Security offered is primary security hypothecation of plant and machinery. Again, when the word hypothecation comes, you should remember what sort of charge is created in hypothecation, who will get the possession, whether the bank has possession or whether the customer will have possession. So these things should run in your mind as you read through the details. Collateral security, equitable mortgage of factory land and building. Again, what are the properties of EMT creation when you deposit title deeds with the bank? What is the sort of charge created? So you can watch this in securities and concept video. Then additional securities, assignment of insurance policies. Now let's look at what are the guarantees provided. Personal guarantees provided of two directors whose net worth is 25 crore each. Then corporate guarantee from a group company with common directors. Okay. Then look at documentation issues. Documentation, DPN and hypothecation agreement is executed but not stamped properly. So what are the consequences if it is not stamped properly? EMT created by deposit of title deeds but not registered within 30 days at the registrar of companies. So what is the problem bank will face if it is not registered with the registrar within 30 days of EMT? Then revival letter pending for old working capital loan. So these are some highlights from the documentation aspect. Then auditor also has raised some issues. High sales return and delayed statutory dues. So statutory dues like tax or GST returns might not be filed. So these are some observations related to this case study. Now, let's look at the first question. As a bank's credit officer, analyze whether loan should be sanctioned under what safeguards. So, you are going to look at this problem as a loan officer and what sort of conditions you should put if you are sanctioning, or what should be the factors you keeping in mind while you are processing this loan. So let's look at question number one. Which of the following best describes the risk associated with accepting hypothecation of plant and machinery as primary security? So the question is asking about the risk bank will face if they are accepting hypothecation as a mode of charge. So you will remember differences between different types of charges. In the concept video, you might have watched the table highlighting differences. That pledge, in pledge, the bank will have holding rights on the goods. Similarly, for mortgage, customer will deposit title deeds, but he will have possession. Bank will not have possession initially. Then similarly for hypothecation also, the customer will possess the property. They will have the physical possession of the plant and machinery or vehicles, whatever the security is. Bank will not have physical possession initially. So that kind of risk is there. Let's look at options. Bank obtains possession and title to the assets directly. Wrong. Borrower retains possession, true, raising risk of disposal without bank's knowledge. There is always a chance that there is risk of disposal without informing bank. Hypothecation is enforceable only when registered with sub-register. Wrong. Remember, we're talking about a company, So for companies, you have to register. If at all there is a registration, it is with the registrar of companies (ROC). So this is definitely wrong. Hypothecation provides unconditional right of sale to the lender. Unconditional right? No, it is not unconditional right. Hypothecation only comes on default. You have to take possession of the security only. Then later you will have right to sell it. So it is not an unconditional right. So all these options are wrong except option B. This is the most valid answer, that borrower will retain possession of the security and there will be some risk of disposal without bank's knowledge. So let's look at question number 2. Since EMT was not registered, equitable mortgage was not registered within 30 days with ROC, Registrar of Companies, what is key legal implication? Option A, mortgage becomes invalid against the company. Remember, mortgage, if it's valid and if it's created between two parties, between the bank and the company, it's properly executed, then it is a valid document. Now, why they are saying register with ROC within 30 days is that tomorrow, in case of liquidation, or tomorrow, if someone else is claiming, some other bank or financial organization is claiming right to this property, then the bank which has registered with ROC will have a priority over such other third parties. So for that purpose, basically you have to register. So the mortgage as it is not an invalid if it is properly executed. This is wrong. Against the company, it is still valid. Let's look at option B. Mortgage remains valid between lender and borrower, but not enforceable against liquidator and other creditors. Yes, this is exactly what we're saying. As per Companies Act, when it is not registered, it will be valid between lender and borrower. The mortgage will be valid between the company and the bank, but for enforcing against some other third party, liquidator or other banks, it will not have priority in case of liquidation, or if some other bank is claiming right to the property, it will not have claim if it is not registered with ROC. Okay, so it will just be like an unsecured lender. Then mortgage can be revived by executing a new DPN. Again, they are testing your concept of DPN and mortgage. See, DPN is for personal liabilities, mortgage is for immovable security. So this is definitely a wrong idea. This is, you can reject it straight away. Mortgage automatically converts into a pledge. Again, wrong concept. Mortgage is for immovable security, pledge, it is used for goods, for movable goods. So this is again wrong concept. So the best answer is option B. Let's look at question number 3. As per RBI guidelines, when can a bank insist on personal guarantee of directors for Zenith Agro Industries Limited? So if you have watched our concept video on guarantees, you will know that RBI is clearly mentioning some checklist which banks can follow to insist on guarantees, and also mentioning, it is also mentioning when it need not insist, banks need not insist for personal guarantees. So clearly there are guidelines. Now let's look at, if you are not aware, just watch the video and come back, you'll be able to answer this easily. First option, always mandatory for loans above 10 crore. Wrong. RBI is not mentioning any such amount. Only when company is public limited with good rating. Actually, the question is for when bank should insist for personal guarantee. So when banks require. So here they're saying company is public limited and it is also having good rating. So that means the risk is reduced. So guarantees you normally insist when you see a visible risk in the loan. So and RBI also mentions that if the company is public limited, good rating, good management, then banks need not ask for guarantee. So RBI guideline says it should always be need based. Guarantee should be need based and proportionate to their risk. Okay, now so the second option is also definitely wrong. When company is closely held or shows financial stress, yes, this is definitely right, because RBI says that if the company is held within a private small group which is closely held, and then there is also financial stress, history of loan default, then banks can definitely ask for past personal guarantee. This is true as per RBI guideline. And collateral security is already sufficient. Again, this is totally wrong. If collateral security is already sufficient, your risk is covered, then why do you need another guarantee? So answer C is the best option. This will be the right answer.